Good morning, good afternoon. Welcome to the monthly One Voice Manufacturing Public Policy webinar presented to you by One Voice, the National Tooling Machining Association, and Precision Metal Forming Association. My name is Omar Nashashibi, the founder with Inside Beltway, your lobby shop here in Washington, D.C. I'm on my own this month, as we've got several of our colleagues traveling to different locations. But as always, you've got the folks here in Washington, D.C. at Policy Resolution Group being your voice as it relates to media. They've had a really busy month related to trade and taxes. Appreciate all those media volunteers that have been active over there. As always, as we go through here, we've got quite a bit on the slide deck, as you can imagine, much of it generated in the last 24 and 36 hours. Please do type in your question in the Q&A box. We'll try to incorporate those as we go along through this presentation and answer any other additional questions as we go on in the end. As always, this webinar is being recorded and you will receive a PDF copy of the presentation along with the recording being posted several hours afterwards today for all of those that registered. Again, today we've got quite a bit. We're going to start up on Capitol Hill talking about the tax bill with a few other changes that you should really be focused on here. We know our associations are hosting webinars on that. Regulatory update, very significant developments from the EPA on endangerment finding related to climate change, and a whole host of tariff activity. Again, just really in the last 36 hours, we try to capture as much of that as we could, given the flurry of activity. But let's go ahead up and start on Capitol Hill, where we believe that this is tax bill that was signed into law by President Trump on July the 4th. It was one of the more consequential tax and just overall manufacturing bills that we've seen in multiple generations. When we look at the Tax Cuts and Jobs Act of 2017, that both organizations worked on and we lobbied on, that was a major win because it cut tax rates. Much of them, though temporary, but it was a tax cut bill. This is an investment bill. This law creates a number of tax provisions that allow manufacturing businesses to invest with certainty that there's going to be some stability in the tax code. When we look, for example, as pass-throughs, which make up 65% of our PMA and NTMA members, according to our surveys, meaning their subchapter S, LLCs, partnerships, sole proprietors, ESOPs, paying taxes at the individual tax rate. That tax rate deduction of 199A at 20% is now permanent. It was slated to expire at the end of this year. The tax on research and development, that is gone. We had a tax starting in January 1 of 2022 of taxation on and having to capitalize and then amortize over 5 years your R&D activities. Regardless of you claiming your tax credit, you were still subject to a tax on R&D if you had any of those activities that were defined. That is now gone, retroactive to January 1st of this year. No more tax on R&D activities. You can fully and immediately expense your R&D, and that's really significant. We look at other countries on the extreme side, like China, which provide in some cases up to 175% credit on certain R&D activities. They're giving money back. And that's something that we watch very, very closely to allow this stability, but went further. What Congress did, and we lobbied extensively on this, not only did we remove the requirement to amortize over 5 years your R&D activities, but for those businesses with up to $31 million in gross receipts, you might have the opportunity to go back and reclaim some of the dollars that you had spent on the R&D if you had not reclaimed on some of the amortization. So that's something you really want to speak with your tax professional. We know that both NTMA and PMA are in the process of already had webinars with tax professionals, and encourage you to take a look at that one. But we are waiting for a little bit more guidance from the IRS on many of these provisions. And bonus depreciation, that's your 100% expensing. Again, for your CapEx, that's your depreciation now is permanent, retroactive to earlier, January 20th of this year. Your interest deductions, your full EBITDA is restored. Small business expensing, we doubled that to $2.5 million with a dollar for dollar phase down starting at $4 million. The estate tax is permanent at $15 million with $30 million filed jointly, indexed for inflation. That's also significant for family-owned businesses, many of which make up our members. We also have other provisions. We encourage you, again, you want to talk to your tax professional. We're trying to advise folks to look at this in non-financial advice way, but strategically looking at the new tax law in 3 different buckets. What does it do for my company in terms of my investment? What does it do for employees from provisions from which they may benefit? And then how does it also have some other areas that are overall related to business workforce activities? So we just showed you in the previous slide how it's going to be directly on the business, but there's other ones such as expansion of what's covered under an HSA, the continuation and made permanent of employer credits for healthcare or credits towards employers for providing employee healthcare. All of those get expanded, made permanent in some cases, and this is one related here to workforce, where it expands Pell Grants starting in July of next year for short term, meaning 8 to 15 weeks, 150, 600 hours. That's something in the Jobs Act that we've been working on since 2015. Wasn't as expansive as we had hoped, but this is a very significant step here to reduce a barrier, frankly, for a lot of individuals to entering into manufacturing careers and skilled occupations. The law now also expands the 529s to allow for post-secondary credentialing expenses, recognizing credential programs, and those are really significant in that these are industry recognized as well for offerings that NTMA and PMA may have now may be eligible for 529 funding if a student decides to switch or use those funds from the start on these kinds of activities. And then one that was made permanent here that doesn't get enough attention, I think, is especially as you're trying to recruit individuals, is Section 127. And this allows a business and employer to provide loan payments, or excuse me, payments of up to $5,250 annually towards an employee student loan without it counting against their income. So that's also another significant provision that was included in this. We are starting to get some IRS guidance. This one just was posted, not really official, but starting to give a little bit more FAQs. Based on conversations we're having in Washington, we should begin to receive official guidance sometime possibly in the month of August, and that's kind of what we're hoping that'll clarify a little bit there as well. There was a question that came in. Again, we're going to do a lot of qualifiers on these, which is what you'll need to talk to your tax professionals. We know that PMA just had their webinar on July the 30th. We know that NTMA's got theirs as well. A question came in: does a building expansion for storage of raw materials in a machine shop qualify to be 100% expense? My understanding is you are going to be looking at potential eligibility there for your bonus depreciation. It would not, though, qualify for the manufacturing production facilities deduction that he created. That's the one that the president said if you place something into service by 2032 and it's constructed by 2029, then you can fully expense that activity. But that activity has to be related to production. So it's very specific. It says software and engineering are not included. There's back and forth on whether a warehouse would qualify. The initial read based on the statute is that no, a warehouse for storage of raw materials for a machine shop would not qualify under the separate depreciation for structures that the president's created specifically for production activities, which does include farming, but warehousing doesn't seem to be. But under this one, you are going to want to look at both 179D for the energy prior to that phasing out next summer, and also on the bonus depreciation, though there might be some eligibility, depends on the rules around the 179 too. So taking a look at those areas. And what we're expecting those to get a little bit more clarity, because again, what Congress writes isn't always what the IRS ends up doing. So we're hoping to get some more guidance from there in the coming weeks here on them as well. Shifting back and staying up to the Hill, we have some developments on where we are on government spending. Met with a senior appropriator close to leadership on the Senate Republican side last week on Thursday. Staffer, she was actually more optimistic than I expected of working with Democrats on getting some of these funding bills. That being said, there were some hiccups yesterday in the Senate on getting some things done. But the key being here is you do not see a column for any of these appropriations bills being completed and sent to the president. And that's because we're very far away from that. The initial hope by some is that they can package together a minibus of certain bills, such as the Commerce, Justice, Science, Agriculture, maybe legislative branch, possibly military construction, VA, put those together and create a minibus and move those together. And sometime in September to avoid a government shutdown, but that's going to be the real focus when they get back. After their break, the House is out. The Senate is slated to leave after doing some more nominations here in the coming days. So they're going to be gone until after September 2nd. We're going to run through regulations. I know everyone wants to hear what's happening on tariffs, and we will certainly spend some time on that. But there was quite a bit of regulatory activity. There are some new apprenticeship guidelines here that are coming up. And what this does is it reverses some of the initial guidance that was put out by the previous administration as it relates to apprenticeships and some of the requirements and the strings that were attached in there. So this is going to be trying to streamline some of those and simplify some of those requirements on program operators and also those entities that are seeking to be some of the sponsors and facilitators that are there. A few webinars ago and earlier in June on one of our weekly calls that we have for members, we did talk about what the Small Business Administration is doing to really change their approach towards manufacturing and in general being more active and not just the backer of 504s and 7A loans and those kinds of things. What we're seeing from them is really a concentrated effort on being more of a bridge and a connector to small businesses and small manufacturers in particular. They have now signed a memorandum of understanding with the Department of Labor for the Small Business Administration to look at cross-agency corroboration as it relates to manufacturing to help streamline some of these programs and expedite some of the suitability and identify the beneficial resources. So there's some really good things that are happening in here, obviously with potential grants that might be made eligible to both PMA and NTMA, foundations and institutes and you and all those. So that's something to take a look at as well. The call that we had with SBA was encouraging. There was a number of categories ranging from CMMC to apprenticeships to MEPs where SBA really wants to seek an expanded role. So we should watch this space closely here in the coming weeks and coming months especially. A few items over the Department of Labor. OSHA is starting to step up a couple of things. They're actually been quite active every single day now, weekday rather. OSHA's putting out a workplace safety reminder. They have, I think, since April, if not since May. And so we're getting these daily emails. They did a National Whistleblower Day talking about different opportunities for individuals. So just note that that is continuing despite the change in administration. Then on the reverse side, OSHA is trying to be more accessible and going back to working with you. At the flashbacks, I made that exact statement during the first Trump administration, but they really are trying to partner a bit more here and have more of an open door and prevent with incidents through a coordination program. And this is the on-site consultation program where they're trying to reach out and show that there is no cost consultations that they're offering in workplace safety. Always consult your legal professional and if you have labor lawyers, but just want to flag that they are starting to promote these kind of items that are out here. Voluntary engagement correction programs. I will flag this one on the VPP, the voluntary protection programs. We've had some members be a part of this with some good success. We've had a couple of members report back that OSHA basically led to a fix-it ticket that they couldn't afford in some cases. So again, case by case, but note that they are starting to try to reduce some barriers for having just open discussions. Same thing, wage and hour division on FMLA and PHLSA, and just showing those opportunities. So for your HR folks, please flag those as well. The penalty guidance. This is one of those spaces where for you smallest of employers, rather, they are trying to provide more flexibility by looking at a potential penalty reduction level of 70%, which was previously only applicable to businesses with 10 or fewer employees. It's now going to allow it for those who employ up to 25 workers. So that's something to take a look at. And the revisions and also allow for new guidelines for a 15% penalty reduction for employers who immediately take steps to address or correct a hazard. So they're allowing a little bit more flexibility there, and that's something to watch closely. Here's the overall guidance for your reference if you ever need it. This is a long document, but you'll need to scroll down. You'll see the section 4, and that'll give you an idea of looking at the exact percentage reductions that they're allowing, since they're allowing up to a 30% reduction here, up to 100 employees, 10% to 50, so on and so forth. Again, trying to be more flexible with small businesses in that space. This one is targeting the efforts by unions to place workers who aren't really intending to actually be true employees, but trying to go into a workplace setting in order to facilitate a union organizing campaign. They're looking at a two-part test, whether the alleged discriminatee applied for employment and possessed a genuine interest in being hired, in looking at that when this putting out in this guidance that came out there. One last final regulatory before we move on to trade. This is significant if it goes through. I know the folks over at Bracewell, they've got a great environmental law practice and lobbying team there that probably are going to do a webinar on this at some point that you all should watch. But here's what happened. In 2009, the Obama administration issued what's called an endangerment finding. What that means is that they found that greenhouse gas emissions from motor vehicles engines contribute to air pollution that may endanger the public health or welfare. That is a trigger that allowed the EPA and other agencies to begin regulating economic and manufacturing activity across the United States. And that is now being charged and looked at again by the EPA through a proposed rule, and that's what's key in this, where they are looking at potentially rescinding the endangerment finding that is the underlying authority that allows them to regulate greenhouse gas and other pollutants under climate law. That's the non-legal oversimplification of what they're doing. Please note it is a process. There's going to be a notice and comment period as a standard, and that's going to be coming up on August 19th, 20th, and possibly and expected on the 21st, with comments eligible for filing up to September 15th. Let's move on to tariffs and what's happening. We're going to go through several quick slides here just to give you some numbers to put in perspective. This one I really like. You'll see usually with our decks, a lot of Bloomberg, Axios, and Financial Times and others that do some good chart work. This one here shows you what we were dealing with. We started off at about 2.5%. The latest number, this one's around 18. I saw Yale, the Yale Budget Lab came out with 18.5% this morning last night with the revised rate. So this is where you can see now where the tariffs are coming in month over month. You did have a number of Asian countries secure lower tariff rates for many of them. I will note that on these here, you've got a high generally of 40%. We won't include China. That's under a separate track. Indonesia just announced 19. That was a reduction. Japan was at 24, threatened to go to 25, then ended up with 15. And we'll discuss that a little bit more as well. And then getting into global reciprocal. This slide will set the stage for the rest. Other than the United States, white does not mean there are no tariffs. There is a baseline tariff now, effective 12:01 a.m., August the 7th, next week, on every country in the world. The word reciprocal is very important here because under the International Emergency Economic Powers Act of 1977, the law that Trump is using, he used it in 3 different key ways. He, in February, went after Canada and Mexico for border tariffs. There are no reciprocal tariffs on Canada and Mexico. They are called the Northern Border Fentanyl and Southern Border Immigration Fentanyl tariff. So it's important to recognize that terminology is different because it has a legal and important distinction. That's why we're showing you the slide here that says reciprocal. China, however, has reciprocal tariffs of 10% plus a combined 20% tariffs through their opioid IEEPA action. So that's a little bit separate. But now what the president's done, he's saying, and this is again an oversimplification, we've got 3 categories. If you have a trade surplus, or excuse me, if you have a trade deficit, so if the United States is running a surplus with you in trade of goods, then you're at 10%. So that is your congratulations, you're at 10%. The US is on the upside, still we're applying a 10% tariff. If we have a deficit, but it's on the smaller side, the administration is moving forward with a 15% tariff if the US maintains a slight or modest deficit. If it's larger than what they consider to be modest, then you're getting a specific number, and that's how you're seeing the darker shades going all the way up to the combined 50% threatened on Brazil, and some of those 40% that you saw in the others, 39% even on Switzerland, and a few others that are there as well, and we'll get into some of those. However, to give himself a little bit more breathing room, the president did extend talks with Mexico for 90 days. And that's significant for a couple of reasons. Why he didn't do so for Canada, and we'll touch on that here in a couple of slides, but the US did provide a little bit of extra time to go for 90 days with the status quo. Now that status quo, that means that 50% tariff on steel and on aluminum derivatives and steel derivatives, meaning products made thereof, remain in place. And that is going to be disruptive for certain individuals and companies that are bringing it in. And the 25% tariff on non-USMCA goods stays in. The border tariffs on non-USMCA qualifying goods come in. And then we'll see where we go from here if he isn't fully satisfied where talks go. So he did give himself a little bit more breathing room on the southern side of the border, and we'll jump back into Canada in a minute. But US, EU trade announcements. This is significant. We kind of held off on putting out what the United States has been saying to see what the European Union and European Commission put out. And this is what the EC has now said, that the commitments are coming out. What's most significant for our members listening here, we'll jump down to the bottom. joining forces to protect the steel, aluminum, and copper sectors from unfair and distortive competition. Global overcapacity threatens EU and US industry alike. Together, the US and EU will establish tariff rate quotas for EU exports at historic levels, cutting the current 50% tariffs while jointly ensuring fair global competition. Let's dissect this. There's at least three things to break down here. One, the question is what? He's looking at steel, aluminum, and copper. So he's adding all of those that now, as of today, have a tariff on it as those commodity imports. Then what he also goes in is he talks about tariff rate quotas. What is a TRQ? TRQs were established but largely reinstated under the Biden administration that allowed a certain amount of metal from the EU, Japan, and UK to enter the United States tariff-free. After they hit their quota level, then the 25% on steel, 10% on aluminum took effect. They did that by country and then by HTS specific steel aluminum product. This is looking to shape up a little bit differently. The model that the Trump administration is using is that they will impose a high 50% tariff rate once the quota is reached, but until the quota is reached, they're leaning towards a lower tariff rate of, say, potentially 25%. And that quota could be the aggregate for that country, could be for the bloc. It's still unclear how they break that down, if they're going to get as detailed by HTS code, which might be too complicated for their liking, rather than just doing an overall number over 2024 imports. And then even in some cases, we've seen them looking at a baseline of 2015 and 2017 levels as the benchmarker of what they want to see under this tariff rate quota system. So to break it down, steel, aluminum, copper, we still have, as of right now, that 50% tariff coming in on European metals. We are looking at potentially a tariff rate quota system. It's unclear at what levels they will allow that, but once they do set those levels, it's our expectations they will have a two-tiered tariff structure. One where until the tariff is reached, it will be at a reduced rate. Once the tariff is reached and exceeded, you will be under that higher, likely 50% rate until there. Then in the middle of the slide, they look at the 15% ceiling here and what they're looking at applying to cars and car parts, currently subject to a tariff rate of up to 25%. So there's still a lot of moving part, and we don't have official guidance. I do not have guidance from Customs Systems Messaging Service on this quite yet. But this is what we know from the EU. As of right now, your metals are still there. What I just said was pure speculation based on conversations we're having in the United States, or in Washington, D.C. rather. And that now brings us also to the United States-Japan trade announcements. And you're going to mirror much of what I just said as we go through the next several slides. 50% steel tariffs are still in place. Possible further discussion. And does that lead us to a TRQ, also tariff rate quota for Japan? We'll see where they end up. But now the Japanese are facing a 15% reciprocal tariff rate rather than that April 2nd, 24, or that July 9th, 25. Those were the two ones that were thrown out. Now we're at a 15% rate that's been put out there. But again, for those of you that are buying tool steel and other product and those derivatives that might be covered, that's a 50% rate that's there on the steel value and on the aluminum as well. Japan's also looking at doing investments. We're hearing that's more of loans. There's a lot of uncertainty and lack of clarity, frankly, on all of these. And that's why you notice that just we're not comfortable using the word deal up here. We'll allow others to use that terminology. These are announcements until we see official things from both sides that are being enacted along the ways. And this is, again, we don't have an announcement. We have the president making a statement on South Korea that the U.S. will impose a 15% tariff down from the threatened 25. And again, 50% tariff. That we do also have Korea being a significant source of tool steel, die steel, and other materials coming in. And that's going to be still subject to that 50% tariff that's on there. In all of these cases, these negotiators from the other sides are not just looking at steel, aluminum, copper. They're also wondering what's going to happen next on critical minerals, semiconductors, aircrafts, medium heavy duty trucks, lumber, softwood, polysilicon, all these other things that they're adding to the list. And that's why we're watching the other side's comments as well. And one that we have not seen really move quite a bit, and you can obviously see the president's frustration. If Caitlin were on here, she would certainly be flagging the all caps that the president used in this social media, Truth Social post. And you can tell that he's getting frustrated that he doesn't have a deal. Most of us here in Washington believe that an agreement with India is the one that he prizes the most, being that largest single economy with which he could negotiate outside of the EU bloc. And so we'll see where that ends up. But Modi does seem to be, I don't know if he's digging in, but pushing back a little bit as well. We're going to just flag Indonesia here for a minute, not because they're a large importer of many of the items One Voice members use, but for some of the precedent that it's setting here as well. They do two things here. They're going to do transshipment building on Vietnam on the next slide, but you'll notice that what they did, the US reciprocal tariff capped at 19%, with a potential further tariff cuts to near zero for goods not domestically produced in the United States. Now, I think they're looking everything from palm oils to, again, coffee, cocoa, and many of these other inputs here on the F&B side, the food and beverage side of it. But I think that if they do open this door for products not domestically produced, then does that also open the door to other countries and other goods, such as those here for industrial manufacturing? And that's something why we wanted to watch that pretty closely, less that it is Indonesia and more so for, are we finding any precedent here that can be replicated? This is the big one that we're all really trying to help people better understand, that rules of origin are going to be the most important three-word buzz phrase that you've got to hear about. And that's going to be one of the challenges that come out. What we are seeing here on transshipment and products that are going to be brought in from overseas, that is something that we know this administration has been watching extremely closely, in particular focus with regards to China. We saw some of this language earlier, and now that we're starting to see this going on in Indonesia as well, where they're talking about the rules of origin to prevent third-party country transshipment. What that means is that the Indonesia third country transshipment, if a product's actually manufactured in China, then shipped to Vietnam, Indonesia, elsewhere, Mexico, then brought into the United States and then that is considered manufactured still in China. It's not country of shipment, it's country of origin. Where's the original country of manufacture? And that's what they are all going to be looking at. So increasingly, it's going to be important to trace this, particularly in your steel and other inputs, and how those track that are out there. Brazil, this is another one they've got a trade deficit, meaning the US runs a trade surplus with the United States. Part of the reason we flag Brazil is this one's certainly being launched by most nonpartisan observers as being more politically directed and less on the substance of trade in many cases. And it's also looking at Brazil being a leader in the BRICS effort, which the president certainly does not like that's out there. So they've launched a 301 investigation here. This is separate from some of the reciprocal tariffs that he's announced. So there's multiple actions that the president is putting maximum pressure, if he can, on Brazil in this process. And this is the 40% that he's looking to impose here starting on August the 6th as well. Back up to our northern border here, tariffs on Canada increased to 35%. I'm going to pause on this one for a moment. So this is technically in effect, and I saw one question coming in here on the EU, and we'll start trying to get back to that in a minute. But on the Canadian side, this one's a little bit misleading. Yes, there are 35% tariffs coming in, but the vast majority of products are still subject to single-digit duty rates on coming in from Canada, in that they are going to be coming in under USMCA. If they're actually manufactured in the US, Canada, or Mexico, for the most part, they don't have a tariff subject to them. And in many cases, they don't even have a duty applied to them. And that's if they're filling out their country of origin certification properly, then they shouldn't have that there as well. So that's kind of where we're focused on some of these areas on Canada. Where do we go from here? Obviously, he's increasing pressure on the Canadians to come to the table, and that's where we're trying to see on products coming in. But please focus on the USMCA, whether or not it is certified, whether or not you got your paperwork, then you're not going to have to deal with the 35% anyway. Jumping back here to the reciprocal tariffs that are now coming into effect next week at 12:01 a.m. on August the 7th. These are the country specific. Remember the three categories. We've got the 10% that if you're not listed, or we really have a surplus with you or not much trade with you, then you're going to go in and see where they go on to the next stage and where they go. Going to the question now that we had on this that came in here. We are getting mixed messages on whether the announced tariffs on the EU, the 15%, includes or excludes the 4.8% duties. For background, which the questioner is referring is a general duty rate that's on the Schedule 1 that you've got, and that number he put in is probably specific to a product. What they are is they're looking at importing the product at a general duty. Every country in the world has these. The US averages 2.6%, for example, coming in. And in Europe, it can be 3%, 10%, 5%, 3%, depends on the product. And so right now, what this will tell us here is that European Union goods with column 1 general duty rate, they're going to be at 15%. So it's our understanding that they're reducing it. We don't have full guidance on here. So what they're saying here, European goods with column 1 duty rate, and then you've got 15% minus that. So they are saying that they're basically, this is a chart, we don't have full guidance since this is just coming out from the White House, that they are saying that they're going to do some kind of calculations of what that general duty rate. So it seems at this point to the questioner that it's a minus and not an and on the general duty rate. So here's why, because I've been getting this question too. The president can't on his own eliminate just the general duty rates there. It would take a process in order to do that, which is why I think they've gone this direction of applying a duty and then subtraction. So that's, I think, where they're going with that. Another slide, keep sliding through these, you can see the other countries on the reciprocal rates. Frank, to your question, is Canada 25% plus 35% or 35% total on aluminum? This is where it gets into the stacking. What they've done is, and you've actually got a 50% tariff on aluminum. So what they do is the auto tariffs take precedent in the stacking order on Canada. If there's an auto tariff, then that 232 auto tariff takes effect. If there's not, then you jump to the steel 232 tariffs. Then that takes effect. If there's no 232 tariffs in Canada, then you jump to the IEEPA border tariffs of 35%. That would take effect. So now reversing that step ladder and going up. Your metals, your steel and aluminum, are still subject to a 50% tariff, regardless of whether or not they're entering the United States under the USMCA compliant. So Canada and Mexico are in a position where you're still paying the 50% tariff on steel or aluminum. On autos, the Europeans are getting a 15%, but your non-USMCA products from Canada and Mexico are at 25%. And then your non-USMCA, non-auto, non-steel, non-aluminum, and now non-copper are going to be at 35%. So I hope that I kind of try to clarify that one a little bit that came in. The question also came in on O&G. Is oil and gas still subject to all of these tariffs? And again, if you've got a question, feel free to type it into the Q&A box. We'll try to get into it as we go through. On the Canada side, they included on that a specific line item, and they created it called critical minerals, and those were going to be subject at 10%. And I haven't seen any changes to those. So on the Canada side, I believe energy is still at 10%. That's there as well. So that's kind of where we are on reciprocal tariffs. Again, we're looking for some more clarity and actual language from customs with regards to the European Union. My emails are not coming through, obviously, right now when we're on this. So if someone sees something from CSMS, please flag it and send it on there as well. A couple other things to jump into on trade. We've talked now about the countries. Feel free, again, please do type in any questions that you got in the Q&A box and jump in on those. But now we're going to get into the sectoral tariffs as we get ready to wrap up here in a few minutes. For those of you, shouldn't be many, but that are dealing with de minimis imports, they are doing away, not just with China, but they are suspending duty-free de minimis treatment on a global basis to deal with some of the emergencies that he's declared, and that will be effective on August the 29th. This is, that you recall, used to be at $200 and under goods could come in, then Congress changed it to $800 and under come in, and then moving on from there. A few other things that come into play here, and when we look at these other actions that came in, this is the big one that we've all been waiting for. On copper, 50% copper tariffs were just announced. We literally just got paper from this in the last 36 hours. And to put that together here, in what we've seen, non-copper content is subject to the IEEPA reciprocal, border, or opioid tariff actions. And that is where you're looking at the situation. So here's how you want to look at this part. If it's got copper in it, it'll be subject to 50% tariff. The non-copper is subject to the IEEPA tariffs. similar to a steel or aluminum action that you're dealing with right now, subject to that recent guidance. So right now, if you're bringing in a steel or aluminum derivative, you've got that's on the covered list. It's the steel or value content that's in there that's subject to the tariff. The non-steel and aluminum is subject to the IEEPA tariff. So they're doing the exact same thing that's on here as well there. However, on copper input, so this wasn't as bad as many had thought, which is why you saw copper prices fall yesterday morning. So they did not include the copper inputs, the ores, concentrates, mats, cathodes, and anodes, and then copper scrap are not subject to it. However, the semi-finished copper is in effect as of today at 12:01 a.m. and also on intensive copper derivatives. Now, I don't have full CSM. I think we did actually, we did get some CSMS guidance on this. But on the brass, bronze, and nickel, this is where we probably need some metallurgists to step in here and clarify. It's our amateur understanding that yes, those semi-finished coppers of brass, bronze, nickel, red metals are covered here as well to take a look at. They are looking at creating an inclusion process similar to steel and aluminum that would be adding more products made out of copper to this 232 action and subject to 15%. And then they're looking at phasing in refined copper tariffs over time in 2027 and 2028. Here's the copper products that are covered by HTS codes. So for those of you that know what you're using, there's a couple of you on this call that do actually have your HTS codes for this product. So do check this out. We do have some members of One Voice that do, according to the Commerce Department and HTS code, probably manufacture something on this list. And so if you are a manufacturer of a product that is on this list, then you have a product that is protected and covered by the 50% tariff, at least the copper contents of which are subject to that 50% tariff, and the remaining being subject to that IEEPA tariff that's out there as well. So looking at those copper content valuations, here's the guidance that came out last night, around 8 or so. And you can see the copper content, 50% duty is to be reported based on the value of the copper content. And how do they describe that as? They define it as the total payment to be made for the copper content by the buyer to the seller of that. So normally it'd be based on the invoice paid. And this tracks exactly with what we've been reporting to you all on the tariff actions on steel and aluminum, that they are going to be looking at invoices and getting those kinds of issues and information to be able to audit and verify what you've been paying out there. To round out the commodities, Canada, this is also under pressure from the United States to crack down on some Canadian steel coming in, or excuse me, Chinese steel coming into Canada that's getting manufactured into product and coming into the United States under USMCA tariff free. That's something that we've complained to the Trump administration about. And so now the Canadians are implementing a tariff rate quota system for different categories of steel for non-free trade agreement countries. And this is something to watch pretty closely because it's also similar to what the US is doing. Effective today, they have a 50% tariff, they have tariff rate quotas at 50%, looking at the last year's levels for non-free trade agreements. And then the FTA levels for countries that have an FTA will allow up to 100% of previous year imports to come in there. And then they're going to start applying tariffs after that, excluding the United States. So even north of the border, they're starting to restrict some of the metals markets that are up there. And that's something to watch closely there as well. Just wrapping up here, just quick 3 or 4 slides on what we see on some data points that we wanted to flag for you. Please feel free to type in any questions that you've got in the Q&A box, and happy to try to address those to the best we can. This is, again, Paul's favorite slide, one that we like to provide every month. Again, if you check out Steel Benchmarker, they've got different other metals. We just throw one on here quickly. And what we see is this is still a huge price differential. We're looking at $327 price here, $28 price difference between the EU and the United States, and then the usual $542 price difference between the United States and China. So you are still paying here quite a bit more for your metals, and that's going to continue to be the case as it has been, as you can see, for quite some time. Imports are starting to fall here. We're starting to see a drop in May and June that's going in on volumes of imports coming in. You'll see those numbers probably continue to trend. Tariff lines collected, I'm not sure we'll continue to put this up here monthly because these numbers are the same as what we saw previously. But yeah, they're on track now. They're hovering at around 26, 27 clip here of their net is around that too. They're not that far off. They're only about a 0.8, about 800 million off in what they're bringing in versus what they're actually taken on there in their net bring. So it's quite a bit. Trading partners data, here's the US exports and trade imbalances to give you an idea between what the US has that's out there. The US, Canada, the biggest buyers from the United States. US exports quite a bit to Canada, as you can see, and also to Mexico. And in addition, that's quite a hefty chunk that we're shipping off to into the European Union. But it's these numbers over on the right that the president tends to focus on in some of these actions. This one's from China, just came out this morning in one of our newsletters that we get, and just thought we'd throw it out here on China export activities that also somewhat tracks with some of the import activity that we're seeing on the US side. So we're going to want to look at the black line here, where you're seeing a drop there in the middle of this year, in a pretty significant drop off in the containers that are going through the ports outbound from China. That's out there. Just a couple others here, two more, we get ready to wrap up, that we've got on US jobs data. This just came out again, 8:30 Eastern time. US added 73,000 jobs. Please note they did revise down quite significantly. The May jobs numbers are now at 19,000 jobs added. Excuse me, the next one should say June. And then they revised the June numbers down to 14,000 were added then as well. They did have a net loss in the United States here of 12,000 manufacturing jobs. Unemployment rate just went up 0.1% there at 4.2 from the 4.1 it was at the previous month there. Manufacturing data, again, this is starting to trend with what we're hearing from some folks, with some slowdowns here and there with some activity, but we'll see how things go now that we've got a tax bill. As always, please stay connected with us. We just posted a podcast this week. It should be airing, if not yesterday, then today, covering over what happened on tariffs and taxes, the timeline that we had it at that point. As always, you can subscribe on any major platform. Please do donate to NTMA and PMA. We do know that both have advocacy campaigns going right now to build off our major successes on taxes. Please don't get overshadowed on these tariffs for what happened on taxes. There's a lot of opportunities for you all to bring dollars home, and we encourage you to do so and to donate by clicking these links here today. Appreciate your time. I know we had quite a bit to cover here. Please type in any questions that you've got. Again, anything that we can't answer today, we're hoping to provide some updates here in the coming weeks when we get more guidance, hopefully over the early next week from Customs Service and Messaging Service. As I wait for any other questions to be typed into the box here, I do want to flag for those of you that do want to get information directly from the government without having to wait from us, not trying to cut us out, but you've heard me say this now 4 times, it's the Cargo Service Messaging System, or it might be Cargo Systems Messaging Service. You type in Customs CSMS there and you want to subscribe to their bulletin. They put out usually a notice a day, maybe a couple, but between now and next week, that is your go-to. It will tell you all the HTS codes to use, and it is the official document of the US government. Do not wait for a Federal Register, for social media. Do not rely on any of that. It's what comes out of Customs and that guidance that you're going to need to understand what's actually subject to a tariff and what is not. Any other questions in here? I know we've covered quite a bit and there's still not full clarity. Again, the White House just put out all of this yesterday, and so we're trying to bring it all together in real time as much as we can. Seeing no questions, just want to flag that our next monthly webinar is going to be done a little bit early. We're going to do it on Friday, August the 29th, I believe it is, at 12 o'clock Eastern. We expect some regulatory action and also some significant IRS guidance coming out on the new tax law that we'll be able to flag, and then we will certainly have some more guidance on some of the reciprocal tariffs that just are now taking effect on August the 7th. As always, please reach out to us with any questions that you've got, any questions that we do not answer. Please, again, feel free to contact us. Thank you all, and we'll talk to you next week, or excuse me, next month.